Hello, welcome to the webinar. We're going to let people filter in here, so we're just going to start in a couple minutes, but welcome. You guys are just hopping on. We're going to start in just a few minutes. We're letting everyone filter through, and we'll get started in just a minute here too. All right, hello everyone. Good morning, good morning. We're going to go ahead and get started. Hello and welcome to our next webinar in the Back to Basics series, Pension and OPEB for Beginners. We're glad to have you with us here today. Before I introduce our presenters, I want to cover a few quick housekeeping items. Number one, this webinar will be recorded, so be on the lookout for the recording later today. You'll check your inbox containing a link to the recordings as well as a copy of the slides. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find the Zoom toolbar, you will hover your mouse over the top or bottom of your screen and the toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polling questions and also complete the short evaluation you will receive afterwards. The evaluation email will be coming from somewhere called Prolera. If you are having trouble seeing the polls, try minimizing the Zoom screen as sometimes the poll question box pops up behind it. You will need to click and drag the Zoom screen around a bit to see it. If you are using multiple screens, check each one as they may pop up on another screen. If that does not work, you will need to disable your pop-ups. Now, I'd like to introduce you to our presenters. Crystal Cabrera is a senior manager at LSL in the Consulting and Advisory Department. She is a former LSL auditor and uses her expertise in the government audits and accounting to assist clients with month-end close, year-end close, and audit readiness. Crystal has been a key member of the training team, developing approaches to implement new GASB pronouncements. Through her experience in government accounting services, she has developed expertise in reconciling grants, assisting with pension and OPEB reporting, implementing GASB 96 for subscription-based IT arrangements, and preparing financial statements. Riley Greenlee is a manager in LSL's Assurance and Advisory Department. He has extensive experience in all phases of local government audits, first-time ACFR implementations, and single audits. He is an active GFOA technical reviewer and holds an advanced single audit certificate from AICPA and has a background in assisting governments for achieving the GFOA Certificate of Achievement for Excellence in Financial Reporting for the first time and beyond. Riley's expertise includes planning the nature, timing, and extent of audit procedures in accordance with the government auditing standards and the provisions of the Single Audit Act under uniform guidance. He also assists clients with the preparation and review of GASB 68, 75, 87, and 96 journal entries, the ACFR, and the schedule of federal expenditures and awards. And behind the scenes is Ryan Domino, partner in LSL's Assurance and Advisory. Ryan Domino is a partner at LSL with a focus on auditing pensions and OPEB since it has become an audit requirement in 2015. He has conducted numerous training sessions for clients demonstrating how to read actuarial reports and prepare the related journal entries. Additionally, Ryan has prepared pension journal entries and footnotes for over 2/3 of his LSL clients. He will be behind the scenes answering the questions through the Q&A box. So feel free to put your questions in the box throughout the presentation. And now I'll hand it over to Crystal and Riley. Take it away.
Thank you for the introduction, Cami. Getting started. So I just wanted to once again reiterate. So I'm Crystal Cabrera. I'm working with the Government Consulting and Advisory Department. Oftentimes I prepare these journal entries for clients and help with different GASB entries as well. So what we're going to do, just kind of a brief overview of the presentation today. We're going to be going over the basics of pensions and OPEB. So we'll be going over some of the terminology you'll need, information you'll need to gather those and prepare your documents, and provide an example of the journal entries. and an easy way to do the allocation for those journal entries. And then once we're done with that, I'm going to pass it over to Riley, the manager in government assurance, who's going to go over tips and tricks and different common errors that you might run into, so that your guys are ready and you can review and find any issues, hopefully prior to the auditors coming out. So just to get started, what do you need to do when you're starting out, right? We need to obtain all of the necessary reports so that we have everything ready to prepare our journal entries. So the first thing you'll want to do is identify what plans and OPEB and pension that you guys have that need to be reported on your financial statements. So a lot of entities have multiple pension plans, or they might have different OPEB plans that need to be reported individually. So you'll want to make sure that you gather everything that you have. If you aren't sure, I typically say look at your ACFR from prior year, and any prior documentation that you guys have, maybe that the person before you prepared in the prior year, just to make sure you're not missing anything. So once you've obtained all of the information on which plans you have, you're also going to want to keep in mind what reporting and measurement periods you're requesting for. So the reporting date, I get a lot of questions sometime on what's the difference. The reporting date is the date of the financials you're reporting for. So for most of our entities listening today, it's going to be June 30th, 2024, right? So that's what we're actually reporting on. However, most pension plans are actually about a year behind. So the measurement period is the date that we're actually calculating that liability as of. They sometimes, like CalPERS, will use a year in advance, right? So, or they are reporting a year behind, excuse me. So that measurement date will oftentimes be a year before. And you want to keep in mind that when you're requesting those reports, sometimes it's titled by the measurement date. So make sure you're grabbing the right report. This year, if you're a CalPERS plan, you're going to want to get the measurement date reported as of June 30th, 2023 for your 2024 reports. You're also going to want to keep in mind that there's differences in what reports you're going to need based on who your actual plan administrator is. So if you have a CalPERS plan, you might fall under agent multiple, you might fall under cost sharing, and you might fall under both. So you want to make sure that you're gathering the information for each of those individual plans, like I mentioned ahead of time. You might also get your pension through SBSARA or OSERS. There's different plan administrators, and they all have different ways to gather those reports. So you want to keep that in mind when you're going through and grabbing everything. Another thing to be aware of, so for OPEB, a lot of times you'll have to request a separate actuarial for that plan. A lot of clients use Foster and Foster, different actuaries that come up with what that plan actuarial liability at the end of the year is going to be. Sometimes you're going to need to request that well in advance, because if you need a new valuation done, it might take them a little time to gather that information. So the key takeaway from this slide is make sure that you find those plans and all of the documentation you're going to need, what reports you'll need, and start requesting now. If you have a June 30th year end, we can start gathering all that information so that you're not running up against the audit and waiting on that information still. All right, so moving forward, this is a kind of an example of what the GASB 68 accounting report will look like. So for example, this is the city of LSL. They have an agent multiple employer plan. And like I mentioned, the measurement date on this report is going to be June 30th, 2023. However, this is for our 2024 ACFR reporting. Keep in mind, there's going to be differences, and I'm going to kind of go into those on how you request the reports and what types of reports we need. So I also want to kind of give an example or a breakdown of the differences between the agent multiple and the cost sharing, because I do get a lot of questions on those and what the difference is. A lot of people don't really know there's a difference or what the difference is, but they just know this is what my plan falls under, right? So with an agent multiple employer plan, you have all of your plan assets and you're going to pool those inside of CalPERS, for example. All of your investments are pooled in there for investment purposes. However, those individual assets can only be used for your city. So anything that you put into that is tracked in a separate account, and that liability is specifically for you, and those assets are specifically for your employees. However, if you have a cost sharing plan, everything kind of just gets put into a big pot, and they can use those assets to cover anybody's pension costs in the pool. So multiple cities have their employees all within that plan. Another key differentiation is most cities, if you have less than 100 employees in the plan, you're typically going to be cost sharing. So just keeping that in mind, that might help you if you're not sure what type of plan you're going to fall under. Moving forward, so this is an example of the schedule of employer allocations. So like I mentioned, if you have a cost sharing plan, you're within a pool of different employers. So you're also going to make sure you grab this report because it's going to have all the different allocations to determine what your specific liability is going to be. With the agent multiple plan that we went over previously, those plans have you're going to request that separately, and then it will actually have your specific liability and all your deferred inflows and outflows for your city. But if you are cost sharing, you're going to actually have to do an additional calculation. So that's why it's important we make sure you also get this report here. If we move forward, we also have some other additional items you're going to need. So once you've grabbed those reports, you're going to need to make sure that you have all of your contribution data by plan for your reporting year. So if you have a 6/30 year end, it's typically pretty easy. You can go into my CalPERS, the billing and payment summary, and grab a summary of all of your individual contributions by each of the plans so that you can use that. If you have a different year end, so like a 9/30 or a 12/31 year end, it is a little different because you have to determine what the different portion between the measurement date and the actual year end date is. So you might have to do a little extra digging to figure out what those contributions are going to be, because we're going to have to come up with the contribution subsequent to the measurement date. Additional items you're going to need. So you'll need to find any prior year schedules that your city or your entity used in the prior year. Like I said, your ACFR is important because you want to make sure that you're starting by double checking against the beginning balances in those numbers. You're also going to make sure that you have any templates or journal entry schedules that you used in prior year, because sometimes with the allocations, you want to make sure that you're using the same numbers or you're rolling forward the proper numbers. And then you also want to make sure if there's any amortization schedules for your deferred inflows and outflows, that you know exactly what those amortization schedules look like. And that's typically going to be key with your cost sharing plans, because we have to calculate the actual deferred inflows and outflows for your plan. You're also going to want to obtain the allocation percentages for the prior year reporting year and the current reporting year. And what I mean by that is your reports on the liability in total, they will provide the net pension liability, your deferred inflows, your outflows. However, you also need to figure out how you're going to break down those liabilities between the individual plans on your financial statement. So if you have a water fund, a sewer fund, internal service funds, and then your government wide, you're also going to need the allocation percentages to determine what portion of that liability is going to be allocated to each of those funds and fund types. Move to the next slide. Okay, so I mentioned prior to this slide, the deferred outflows and contributions. So when I am kind of training my staff on this, a lot of times we get a question on what necessarily the measurement period, how that affects the deferred outflows. So what you need to do is think about how your measurement date and how your reporting date are kind of affecting your financial statements. So when you have your contributions throughout the year that you make, we naturally would assume that those are going to reduce our pension liability because we're making payments towards those liabilities. However, because of the fact that PERS and all the different pension administrators are reporting on a different measurement date than your actual reporting period, they measure that liability as of a specific date and time. So they say at 6/30/2023, this is what our liability is. But they're not taking into account all of the different contributions that we made during this year, because they don't have a crystal ball to be able to figure out exactly what those are going to be. We've already calculated it at this day. However, you can't necessarily just expense those costs that we've paid into the pension because they're not necessarily expenses. So we need to figure out exactly what that portion of those contributions is that we paid to CalPERS or SB Sarah that we haven't necessarily seen a reduction in the liability yet, but it's going to be reduced next year. So that's why it's important that you get those contributions, because you're going to have to show an additional deferred outflow for those contributions so that next year you're showing that it's going to actually reduce that liability. So if you have, like I said, if the same thing is going to happen with your OPEB. So OPEB is a little different because it's specific to your agency. So you might have a measurement date as of the actual reporting date. And so you won't have any deferred contributions because everything is already included within that. But you also might have a measurement date that could be a year, 6 months before. So it's also very important to just review that measurement date and make sure you're calculating your contributions that were made after that. We want to make sure that we're calculating the right amount. And with that, let's move to the first polling question. So, what types of pension plans does your agency have? Do we have agent multiple employer, cost sharing, both, or is there really a difference? And you guys can answer as honestly as possible. Sometimes you're like, I gotta go look back. And keeping in mind, yes, I have seen both. So sometimes you'll have a agent multiple plan for your miscellaneous, but then like your fire or your police might end up falling under cost sharing. So keeping that in mind, because you want to make sure you're not missing anything.
I'll be closing the poll.
Okay, so it looks like we do have a lot of cost sharing folks on the line, some both. 4% of you don't really know if there is a difference. That's okay. Hopefully by the end of this, we'll know. Let's see. And then let me close that. Okay. So now we're going to go into how to record those journal entries. So like I mentioned before, with the agent multiple plans, we have the liabilities are kind of given to you. So those are my favorite. If you don't necessarily have those broken out for you, so like if you do have a cost sharing plan, you will have to actually calculate what the individual net pension liability, your inflows and outflows will be. So when we are looking at this is an example of the miscellaneous net pension liability. If you can see down below, it's kind of tiny, but the pooled cost sharing plan right now is at about $5 billion in the liability as of 2023. So when you're looking at this, like I mentioned, if it's already calculated for you, the agent multiple plan will be pretty straightforward because you already know what your ending number is. So you essentially just have to plug to get it there. The cost sharing is where it gets a little difficult. So when you're thinking about this, so if I know that the $5 billion liability is here and I have my portion is 5% of that. So then I would essentially just calculate 5% of this ending number. And then that's how I would come up with what the individual, my individual liability is. But what you need to do is also look at the prior year because that cost sharing calculation does get a little difficult. Let's move forward. And then, like I mentioned, so we also have these deferred inflows and outflows of contributions. If you have an agent multiple plan, those are going to be your numbers as they are. The one exception will be your deferred outflows of resources. So right here we have 1.3 million, but this is not including your deferred outflows for contributions. So you'll have to add that number in here and it will be slightly different than your actuarial report. So just keeping that in mind when you're kind of reviewing through and making sure that we're including everything. And these are kind of examples of the agent multiple entries, right? So if you are thinking about what entries, how do we even get started? It's really only 3 entries that you're going to need to record. So you're going to want first to reverse that prior year deferred outflow of those contributions, because like I mentioned, last year's or this year's contributions haven't really been reflected yet, right? So you want to consider the fact that We made contributions last year. They weren't reflected at first, and they're basically sitting as a deferred outflow in our beginning balance. But this year, we get to remove those and we get to show those reducing our liability this year. So that's what the first journal entry will essentially be doing, is removing those prior year deferred outflows and reducing that net pension liability. The second journal entry is for this year's contributions, where we have spent the money, we sent it over to CalPERS, but we haven't actually seen that reduction yet. So we're going to remove the pension expense because it's not really an expense, it's a reduction of the liability, or it will be next year. So we're going to remove that expense, and then we're going to set up a deferred outflows for contributions. And then finally, you're going to move on to your third entry, where you're essentially just going to take the change from prior year's balances to this year's balances. So you're going to take last year's deferred inflows, and we're going to true it up to come up with what the deferred inflows are for this year. And same thing with the liability. The one thing to consider when you're taking the change on that liability, and I'll show you this later, is just remembering that we did remove some of that liability in the first journal entry. So just making sure that at the end of the day, that ending liability is going to be whatever it is on that report. So let's show you. I'm coming up with an example because I know we all love numbers. So just a very basic example. If I have a net ending pension liability on my report is $1 million. I have deferred outflows on that actuarial report. So in that schedule that I showed you previously, we have $100,000 as our deferred outflows. We have deferred outflows for our contributions of $50,000. So when we look at that table previously and what's going to be on our footnote, the total deferred outflows will be $150,000 this year. And then we have the deferred inflows for $50,000. And then I'm giving just a very basic allocation. So like I mentioned, you're going to have to determine how to come up with this. So if we have 75% of our pension is actually being paid for in general fund and our special revenue funds, we'll have 75% of the liability will be allocated to our government wide. If 15% of those pensions is actually being allocated out of the water fund, then that's how much we're going to come up with as our liability. And then for your fleet fund, I'm coming up with a 10% for your internal service for the fleet. Keeping in mind that with the government wide, you're also going to need to come up with what the functional expenses are, because we can't allocate the pension expense just to pension expense. So you're going to need to know more or less within those funds, like your general fund, how much of it goes to safety, how much of it goes to general government, public works, parks and rec, and all of that. So just making sure that when you're coming up with that, you're keeping that in mind as well. A lot of times cities get this allocation just by taking their trial balance and determining, looking at all of the pension expense for this year, this is the amount that went to this fund, this is the amount that went to this function, and that's how they come up with that. And just making sure that we are reviewing that yearly, because sometimes I do see cities that just kind of keep rolling forward with the same calculation, but that doesn't necessarily mean that the allocation is correct, because from time to time, what funds are paying for the pension is going to change. So just keeping that in mind as well. So using those, I know that everybody totally remembers all of the numbers that I put on the last slide, but just so that we have, and I needed to actually show additional numbers because we need to look at last year. So this is kind of giving you a breakdown of everything within those funds. Like I said, I broke it out between 3 different funds. And how are we going to come up with that journal entry? So the first journal entry, like I mentioned, is going to be to reduce the net pension liability for last year's deferred outflows of contributions. So the 2023 deferred outflows of contributions, those are what's going to be on your act for last year. If you look at that schedule, my prior year deferred outflows of contributions will be $5,000 in the footnote. And this year, we get to recognize that that's going to reduce our liability. So it's debiting that liability, and we're going to remove those outflows because they're not going to be there anymore. But in the following entry, that's where this year's deferred outflows, we're taking them out of our pension expense, because as we've gone through the year, we're recording it as an expense, but it's actually going to be next year's reduction in liability. So we're going to record this as a deferred outflow contribution for this $10,000 that you see in the 2024 column. And this is kind of just a broad example of everything. However, in each of these individual funds, you're going to see that the journal entry is going to be essentially the same. So for government wide, it's going to be $4,000 instead of $5,000, and then $7,500 for this year. And water the same. So water will be $1,500 that you're going to turn into a deferred outflow this year. Hopefully that's kind of clear. Another thing that I do want to point out is being careful when you're doing this allocation to make sure that you are using 75% or 15% of the total ending number. Whoop, let me go back. The total ending number, not the change. So I do see a lot of times that folks will end up using the change in this, and then that's what they allocate the 75% to. And you're thinking, how does that work out? Trust me, it does. But the problem with that is that it ends up where your ending liability in each of these funds is not the actual percentage. So what I mean by that is if I take $1 million and I allocate 75% of that, I know my ending government-wide number needs to be the 750,000. But if folks are taking the $250,000 change from last year to this year, and they're taking 75% of that, they're going to not end up with the actual 750,000 at the end, and you're going to come up with a different percentage altogether. So another check kind of to do is just to make sure at the end of the day, I should be able to look at my government wide and take 75% across all of this. And if that's the ending numbers I end up with or in my water, then I know that I did the allocation correctly. But like I said, just making sure that you're taking 15% of this 1 million, not 15% of the change in each of these different classifications. Okay. So now we're going to be moving on to, this is an example. I'm just going to take the fleet fund just because it's easier to look at one specific fund, right? So looking at this, like I mentioned before, our first journal entry, we're going to reduce that net pension liability by $250, which was the prior year deferred outflows. So we're removing those deferred outflows. And then in the current year, we're going to actually end up deferring the current year outflows. So we're going to defer the 1,000, reduce the pension expense. Now this part is where it gets a little trickier. Typically, we know these are the deferred outflows here, 600 or 6,250. These are the deferred outflows that are on our agent multiple plan report. So this is the change from the prior year outflows to the current year outflows in the fleet fund. So we know that we need to increase this number by 6,250. And so that's why we're debiting that here. For the deferred inflows, we are increasing those deferred inflows by 3,750, which is a credit balance because your inflows are actually a credit balance. So that's what we're doing here. The key part though is, like I said, to remember. So for the net pension liability, the change in the net pension liability this year is 62,500. However, we're actually going to reduce the liability for 62,750 because we already removed part of it here. So we need to basically get to this number at the end of the day, but because we reduced it already by this, we're going to increase it by 62,750. So hopefully that makes some sense. It's just keeping in mind, you're trying to get to this number at the end of the day. And the reason why it's different from the actual change is because of the fact that we already addressed part of that in this first journal entry. So making sure that at the end of the day, when you're double checking, you want to make sure that your net pension liability agrees to this number. Other than that, I think you should be good with this allocation. So this is exactly how you would do it in the water fund, in your government-wide fund. And then basically your plug is always going to end up being pension expense. And with that, let's move on to the next polling question. So who is preparing the GASB 68 and 75 journal entries at your agency this year? So is it going to be your responsibility and you're super excited about that? Or is it another person in your department's job? Do you have someone outside your agency preparing this for you? Or are we not even sure who's going to do it this year? We're just trying to figure it all out. Let's see. I know these journal entries can be a little daunting at first. I was pretty hesitant a while back as well, but I think once you just kind of keep in mind, especially for the agent multiple, you have that number to tie back to. And then once you do the allocation for the cost sharing, you do have a number to tie back to. So honestly, in the end, after SPIDAs, I feel like this is now one of my favorite GASBs, just because of the fact that I do like to have that check figure. And it's not so much up to judgment. It's just a calculation that's already there for you. Alrighty, let's see. So most of you, it looks like about half have someone who is going to actually else be presenting this, so that's good for you guys. And then about 15% have an outside agency preparing, so you guys are the lucky ones. Let's see, we're gonna move forward. So I'm gonna be moving on into the cost sharing plan. Keeping in mind the journal entries are essentially exactly the same. The hardest part with this cost sharing plan is remembering that you have to actually calculate those different proportions. Now, this is an example of what the different tables will look like in that very first, back when we were showing the examples, that schedule of proportions that we have from CalPERS. This is exactly what they give you. They basically say for your miscellaneous risk pool, they're going to give your specific agency an employee allocation factor. And you will have one allocation factor for your total pension liability. So that's essentially the full liability that's within that plan that's related to you. And then you're also going to have a specific allocation factor for your fiduciary net pension allocation. So your fiduciary net position, for those of you who don't know, is essentially it's how much is in there basically to offset that liability. And then once you have, it's your assets and everything that are offsetting that. So your net pension liability is the amount that we show on the books, which is the net of that total less that fiduciary net position. So keeping in mind, you do need both of these. And also there is separate, if you use cost sharing, there are separate allocations for the miscellaneous and the safety plans. So you need to make sure you gather both. And there are also two separate reports. So I didn't mention this previously, but if you use an agent multiple plan, you actually need to request those plans through my CalPERS. You have to go in and order those. So making sure that you're ordering those in advance. But for the cost sharing, these are already on the website, so you can go in and grab them now. So like I mentioned though, making sure you're grabbing all the right reports for this. If you need a safety and a miscellaneous cost sharing plan, you'll need two different reports. But the liabilities are all, the proportions are all within the same report. So it's three technically that you would need if you have two different plans. Let's see. Whoop, okay, now just to kind of give you an example, this is an example of the LSL template that we use to report our for the clients that we do prepare, because this can get a little difficult, just how we calculate what the deferred inflows and outflows are, and that net position, the net pension liability. I don't know, some of you, if you are audited by us, might have been using this template in previous years. I know CalPERS does also provide one. So just making sure that you're grabbing the same template from last year so that you know exactly how you calculated it in the prior year or the current year. Because like I mentioned, this is just kind of how you come up with the actual net pension liability for your plan. But there's also different deferred inflows and outflows, which I'll go on to on the next slide. Some of them are specific to your plan. So with those, you're going to have to kind of calculate those specific to your agency, and then those get amortized over time. So you want to know what your balance is and what your future balances are, because those are going to be amortized over the expecting remaining service life. So unfortunately, I can't kind of walk you through this just because I'm limited on my screen sharing, but this is kind of an example of what a template would look like. You would enter in those proportions that I had mentioned on the previous slide, and then it essentially takes everything from those reports, like that 5 million is that amount that we saw previously, that big, huge 5 billion, excuse me, is that ginormous number that we saw on there. And it's essentially going to take the percentage of this to come up with what your specific entity's liability will be. And then this is another example. So once everything's been entered into there, it's going to come up with these different deferred inflows and outflows. One thing to be aware of though, so certain ones are not included in here because these are the only ones that are reported for the cost or for the total cost sharing plan. You have different, like your net differences and proportions. Those ones are going to actually be specific to your city based on what's being paid out. And so those need to be added in addition to this schedule. Let me see. And that's kind of what you'll see here. So this is the deferred inflows here. for your CalPERS report. So this 137 is going to essentially be the amount for this CalPERS report, but you have employees specific inflows and outflows also that get calculated that will also be increasing your total deferred inflows and outflows. So once all of this has gone through and you've entered all of that in there, then you'll be ready to prepare those journal entries. Keeping in mind, a lot of entities I know are now reaching out and getting separate reports done. Like a lot of clients I've seen use like Foster and Foster to come up with the actual allocation for them, so that they basically just have to take that report and then they can calculate what the allocation is. This is another way to do the allocation, but just like those journal entries I had mentioned before, you're basically just going to, mine are flipped, but you're going to reduce that liability, record the deferred outflows reduction, and then you're going to do the same entry for this year's deferred outflows and contributions, where you're going to defer those this year, reduce the pension expense. And then if we move on to the next slide, you're basically just going to take prior year's amounts, the current year deferred inflows and outflows, you're going to figure out what the difference will be, and then that'll be what you end up adjusting for in your journal entry. So that's very, very basic for the cost sharing, but like I said, I really couldn't get too into the weeds. But if you guys ever have any questions or are looking for any ways to adjust your template, just feel free to reach out. Let's see. And with that, I'm going to actually move this on to Riley, who's going to go over the preparation and the documents for the audit.
Yeah, thanks, Crystal.
Of course.
Yeah, so we're going to shift gears here, start talking about the audit side of things. So when your auditors come in, we're going to go over some items you can prepare ahead of time, some of the specific items that they request, when they want to test these plans, they want to test your entries. And honestly, like, why the heck are they asking for this stuff anyways? I think that's a great question to pose by anybody. A lot of these will coincide with what Crystal took us through. So we'll hammer down some good concepts again. And really the point I'm going to hammer home here is there shouldn't be too much that pops up that you're preparing specifically for your auditors if you've done all this stuff that Crystal took you through, correct? They should be able to reference all your support and look at those things, and these plans should all make sense for them. To be honest, I find, with a lot of our check figures and stuff that, some of the best pension and OPEB stuff that I review from organizations that I audit, they're looking at the same check figures and the same items that I'm going to mention here. So I'll kick it off here. Poll question. I want to gauge everybody's confidence in their GASB 68 and 75 entries. So are they perfect? Maybe you can lead this webinar next year. Could you use some review, but you're feeling pretty confident? You just push it off, let the consultants or try to push it onto the auditors, or you're still not even sure, what's a GASB 68 or 75 entry. Yeah, I know, especially going over those cost sharing plans and those fun allocation calculations, it gets confusing. So you can be honest here.
I feel like most people are confident if they don't have a cost sharing plan.
Let's say I probably hear that as well. Good thing is a lot of these plans don't change year over year. So your cost sharing reports that you're pulling, like if you have CalPERS, for example, it's the same allocation report each year. You can look up your organization. All right, poll closing. Let's see. That's great. 55%, pretty confident. There's 11% of us that could lead this webinar next year. So I'll reach out to you, get you in here. And maybe we'll change some. I'm not sure what this means, by the end of this webinar. All right, so jumping into it. So what kind of items your auditors ask for? Well, generally, if we're talking about a pension plan, an OPEB plan, if it's cost sharing, age multiple employer, a lot of the requests are pretty much the same. There are some differences that pop up, especially between, say, like a cost sharing plan and agent plan, especially around some of the census data stuff, which we'll cover when we get there. So the first and most important item that I'll hammer home here is they're going to ask for your actuarial valuation reports. We're going to need it for every pension plan and every OPEB plan that you have. So Crystal went over these, but these need to make sure that they're for the appropriate fiscal year with your appropriate measurement date and the appropriate valuation date. As Crystal mentioned, sometimes they list them by the measurement date. That doesn't exactly mean that it's going to be the financial year that we're auditing. So just double check those dates, to make sure you're on point. Quick reminder, for both GASB 68 and 75, valuation date is no more than 30 months and 1 day prior to the fiscal year end. And your measurement date is consistently applied from period to period. So for example, if you have, your measurement date is always 1 year behind your financial statement date, it's always going to be 1 year behind. That never changes. So for most of you here, if you have your plans through like say CalPERS or SB Sarah, they're generally 1 year behind for the measurement date and 2 years behind for the valuation date. Along with the actuarial report, your auditor may also ask for your plan's audited financial statements. And if you have a trust, that asset side of it for those agent plans or your trust for an OPEB plan, they'll probably ask for the fiduciary net position report as well. I say may because a lot of this information can be publicly available, especially through like CalPERS. So lucky you, if you have CalPERS, your auditors may be able to obtain it. But it never hurts to obtain these items, go through them yourself. At the end of the day, these are your plans and you're responsible for reviewing like the opinion of those plans when they're audited and all that's reported in them. It only helps you be prepared and better understand, what you're looking at and then ultimately what we're looking at. Finally, your auditors are going to ask for, any of the supporting data behind this. So your journal entries, your schedules that you're using to prepare those journal entries. So Crystal shared the LSL example that we send out to a lot of our clients, how you're calculating your allocation for the year, how you're allocating amongst your funds. We're going to need to see all that information. It's going to help speed along our process. In addition, your auditors are also going to need the census data provided to your actuary for that year's plan liability. They use that data to develop the liability, your deferred inflows, your deferred outflows. It's really a list of all the individuals at your organization that are eligible for that valuation date and that report. So it has all that good information like their employment status, date of hire, termination, retirement dates, birth, gender, all those things that really they use to calculate what benefits are owed to that employee. So let's jump to the next slide. So why do they need this stuff anyways? I mean, to simply put it, under auditing standards, your auditors have to gain assurance over the pension and OPEB items you book in your financial statements. We want to obtain our reasonable assurance, you hear that thrown around, so that we can give you that clean audit opinion letter that you're going to include in your financial report. So what are we looking at? Well, first we talked about your actuarial reports. We want to make sure that those reports actually agree to your financial statements. They're properly obtained and reviewed by your organization. As a personal point, if I'm auditing your organization's like pension OPEB, the very first thing I'm going to do is look at your actuarial and make sure that it actually agrees to the financial statement you've given me or the general ledger that you've given me. If it doesn't, I'm going to stop right there because underlying information is probably off somewhere underneath it. But once that agrees, I'll dive into the journal entry, look at where you're recording your costs, how your change for the year is allocated amongst funds, if that's applicable. We'll talk about some common mistakes in a little bit, but I will call out here, I'd say 90% approximately of the errors that I do see revolve around the allocation and actual change entry among your funds when recording, your entry. So those of you who operate with one fund, tune me out. You have an advantage here. No allocation amongst funds, 100%. You get one clean journal entry. I know Crystal called this one out as well. another key item that we're going to look at is your subsequent contributions. She called them your deferred outflows for contributions. But we'll do a quick refresher. Contributions are the amount, these contributions are what your organization made to the plan between the measurement date and your financial reporting date. Because these items are after the measurement date and not recognized in the liability that your actuarial has to prepare, they're deferred to the next year, taking that expense off your books. So some of you already might be thinking this, but yes, that does mean if you are one of the few that has a measurement date equal to your financial statement date, it's the same year end, you won't have any deferred contributions. The actuary will have access to that information, you'll provide it to them, and it will be all included into that liability as a reduction to it. So for support for these contributions, typically what we'll ask for is say like a contribution report or some sort of payroll report to substantiate that your organization did contribute that amount to the plan during the time and ultimately that it should be deferred. This is important because we need to tie them to your journal entry and make sure you're pulling the right amounts. Honestly, this can be stuff that you could pull from your plan's portal. I know, your MyCalPERS portal has a contribution report that can be run pretty easily. For most of my clients, I'm happy to walk them through how to do that and run those reports. After this many years, we've been through MyCalPERS and SVCR enough times to take you through that in our sleep. But you can also, provide any other payroll reports that you may use to come up with that number. If your system allows you to run exactly what's being contributed, we're happy to take a look at that as well and can be sufficient evidence. So let's look at a quick example of this. So I want to call out a specific example and look at like when I'm tying things out, what are we actually looking at? So you see the screenshot I have here on the top is from an actuarial valuation report. Yours might look a little bit different, but they're all going to have this information. And then the bottom, I have a screenshot from an actual ACFR of client that I pulled. So the first thing I'm checking here, like I said before, does your net pension liability agree to the dollar for what is recorded in the financial statements? Here we can see it does. The report shows we got just under like $15 million for the current year, and the financial statements have that same amount. Important to mention though, if you have multiple plans and therefore you've got multiple liabilities, for example, the concept's still true. You would just have to total all those different plan liabilities in your reports and agree those to the financial statement. So if I were to give you a quick example, say you have a miscellaneous plan for $15 million and a safety plan for $5 million, I would expect to see $20 million as a net pension liability sitting on your financial statements. This could be a great check at the end, like Crystal said, make sure your allocations are good, and that final number is what you want it to be. The other thing I'll mention here is if you're an organization that has multiple funds that you're allocating to, so say you have like a water fund that gets a share of this liability, or you have an internal service fund, those you can also agree, and I'm going to agree as your auditor right from the start as well. It gets a little more complicated, but it should be part of your normal entry checklist anyways. But we want to make sure that, if the water fund is supposed to get 10% of that 15 million we used in our prior example, I should see that 1.5, 10% of that 15 million is what's shown on the pension liability for the financial statements of the water fund. So you could apply that to any of those full accruals and check those out. So let's jump down one more. Thank you, Crystal. And here we actually have an excerpt from the deferred outflows and inflows table on the left, and then on the right, just further down on your financial statements. This table, I've seen it in a few different forms. Usually it looks like this. I promise you though that it is in every single actuary report. You can find it. If you're having trouble, we're happy to help you locate it. I know a few like of the OPEB actuaries, like I think maybe Foster and Foster does it in a little bit of different form. But yeah, it's always there and it's required to be there. So same concept here. We're looking at agreeing these items, and both of them do. So you can see the 6 million agrees and the 1.1 million agrees to what's in the deferred outflows and inflows. But here's the important note. We previously mentioned, through those subsequent contributions, this actuary actually had access to the contributions. They ordered the report late enough to where they were incorporated in the report. For plans through operators such as like CalPERS, this is much less likely to be the case. So when we're looking at those valuation reports, you have to do a little math to get your amounts to tie. So deferred outflows on your left column there will not agree. You have to take the reported amount from the valuation and add in what those subsequent contributions are that are in your entry. So say in this situation, we weren't given the amount and there was an additional $1 million included. Well, I would expect the financial statements to be that $7,380,432. You can do it alternatively. You can take the deferred outflows and reduce that from your GL or your financials, whichever way you go. It doesn't matter as long as you get to that number and you understand, what the difference is here. Let's see. So let's move on and talk about census data. So auditors are required to perform some substantive procedures over census data, especially when there's a new one. And we're always required to test your plan contributions. Since the underlying data changes when you get a new valuation date, we do have to test it. For most pension plans through like CalPERS, OSER, and SB Sarah, for example, they do this every single year. These plans actually reevaluate your plans each year and issue a new valuation. For a lot of your OPEB plans, it's more common to use the same valuation date for two years in a row. It's taking advantage of the GASB requirement. Going back, valuation date must be within 30 months and 1 day of your fiscal year end. Probably also because your organization will save a little bit of money. It's generally a little more expensive to get a whole new valuation than it would be just to roll that data and get a new measurement date. And a reminder to hammer it in, we talked about measurement date never changes. So you may not get a new valuation date for your OPEB, and even your pension maybe, but you will always get a new report and you will always get a new measurement date, because that difference between that measurement date and your financial reporting date never changes. So some of the most common items that we use to test this is we might ask you for a listing of all your like new hired or terminated employees between your last valuation date and this new one. Basically, this is the change. These are the employees that are being added, status changed, or taken off between that last date and the new one. Oftentimes, they'll make a sample from this list and want to verify, some of the employee information using like a personal action form or a time card or some other employee files, and verify pay rates, statuses, gender, even social security numbers. All that's being reported in the census data to your plan's operator correctly. And those employees are ultimately classified correctly for benefits. Side note here, if you're a new auditor, then if you do have a new auditor, they may elect to test the entire census population instead of just the changes to the plan. Sometimes this allows them to set a new baseline rather than just relying on the old auditor's work. I will note census data is probably the only area that really differs a little bit from cost sharing plans, because cost sharing plans are in those pools. They get audited at a very high level. So your auditors may take a more top level approach and look at more just the communication of the information between you and the operator. For plan contributions, these are tested every year by the auditor. Unlike the census data, this is always current year information. So we're looking at a list of personnel or payroll registers and trying to agree that the information you're providing currently throughout the year is correct and the operator is recognizing the correct, pensionable compensation or other changes to like status. So kind of summarize this section in general words for you, because I know it's a lot of different measurement date this and valuation date that, and it gets really confusing. I find the dates moving around is really confusing for people, and that's where people get lost. Auditors want to make sure that whatever information that you're recording in your payroll records and your HR records is accurate to what's being reported to your plan operator, and ultimately those employees' benefits are calculated correctly. So if there are differences, in auditor calls one report something else, it always helps to ask the question. The information they're looking for is the same. We're trying to verify the same thing. And once you understand that, it becomes much easier to move forward with your auditor. Let's jump down. We know we're running a little short on time. Quickly, I want to go through some common mistakes that I see. All right, so first, I'm going to hammer it again. Actuarial report does not agree to your journal entry. It's the first thing I'm going to check. If it doesn't agree, then I'm not moving forward probably with anything else. I'm going to send it back to you and say, hey, what the heck is going on? The second one is the most common one, as we previously talked about. Something's off with your allocation to funds. Your water fund, I expect to see 10% of that pension liability. I don't see it. It's something different. A lot of people will apply the percentage change to the actual change. Crystal did a great job of going through that entry, and there is a difference between, are you booking the 10% of the change or actually just booking to the final amount that you're calculating. A couple areas I've seen too is, rounding balances. We try to calculate out, we'll get real specific for the allocation to a fund, and it's 10.256, some string of numbers. We like to round, we like to simplify calculations, but sometimes that makes our total doesn't tie to 100%, and that can throw your entry off. Another area I see is in footnotes. A lot of questions around this, and footnote information I see is not updated. As a general rule of thumb, it's a good idea. Pull your plans, financial statements, get your actuarial, start going through. They get updated every single year. Some of those assumptions might not change, but a lot of them do. So just put it in your checklist for preparing for your auditors. Go through, update all those discount rates, inflation rates, contribution amounts, allocation, all that good stuff. It likely has changed, so it's worth it to take the extra time to go through it. Finally, the last one I get, and one I think most people run into trouble with as well, is the difference between valuation date and measurement date, and what information your auditor is looking for, and for which year, is this applicable? So hopefully everybody's getting a better grasp now going through this, but we'll just kind of hover over it one more time. As discussed prior, auditors are primarily going to test your valuation year. So they're going to test that census data, and they're going to test your financial year. So what actually is being reported in your financial statements. Just quick reminder, typically that valuation is 1 to 2 years behind, underlying data, and then your measured data for your actuary that they're using, usually about a year behind. Other tips and tricks. So we'll wrap up just real quick on this. First is My CalPERS. If you're lucky enough to have a plan through the CalPERS system, they do offer like business partner access. You can always reach out to your operator and see if there's something like this available to you. This is a great tool. It takes usually about 3 to 5 business days to set up. You just fill a form out online. Auditors can jump in there, run reports, pull a lot of, contributions amount. They can pull like covered payroll for your footnotes, verify a ton of information. Can be super helpful. Consultants, sometimes consultants are the answer too. We have a lot of pride in our industry and our work. Unfortunately, there's a shortage of accountants and increasing workload. So there's nothing wrong. Sometimes that's just what you need to do. Oftentimes it could be cheaper. So it never hurts to take a look at it. Quickly, I want to get a quick poll going here. So we'll see who administers your plan. And then while we talk about that, while we go over that, I'm gonna talk about the last tip here. So templates and SOPs. This is one of the most important things I see, especially when you're talking succession plans at your organization. The more you document, a template for your journal entry or a statement of procedures, anybody who comes into that new role, it gives them a guide. It lets them go through with consistency. I've seen too many horror stories where somebody retires and, it's a manual journal entry you've been using for all these years, and people don't know where these links are coming for in the Excel, and you have to basically start all over. Any time invested into putting together an SOP is time well earned on the back end. Many firms, including LSL, will even help you do that these days or go through the controls. So definitely worth consideration, and would definitely be a recommendation I would always give someone. And here, last one. CalPERS, that's, to be expected. Oh, not too many OSERs and SB Sarah. Okay, good to know. Good to know. All right, well, thank you, everybody. Take some time for some questions. Do we have anything? Looks
Riley,
like
I think there was one for you in the chat, if you want to scroll up a tad.
we had some in the chat. Okay.
Yeah, it looks like, let me see. Oh, I'm sorry, Q&A. So you want to pop in there?
Our city
Yeah.
received a GFOA comment about reporting the portion of our pension liability due within 1 year. We never have. This is actually one that I found last on one of my clients recently. I feel like this is a newer issue that they're coming up with. Riley, have you seen this? I don't really like it at all because I mean, I understand you need to present part of that liability as current, but it just makes it such a hassle to tie it all out.
I've only heard of it one other time. I think we've always been of the mindset that pension liability is long term.
Right.
So I don't personally like, you'd have to think how we recalculate a short term portion of that pension liability. We'll see if it becomes maybe more common amongst the technical reviewers. Not super familiar there.
I think now that I'm thinking about it, actually, the client I had, it was for the OPEB. They wanted a current portion of the OPEB. And I think they basically came up with whatever the contributions would have been for this year. Or for that year, that's what they broke out as the current portion. But yeah, that's definitely one that I saw for the very first time, like in the last month or so. So I think probably we might end up seeing that a lot more this year.
Actually, I have a note here too. Ryan has actually heard of this, that there is a requirement coming out. So we're still looking into it. As we find more information, we'll release it to everybody, and hopefully have a good solid answer here coming up soon. Did we have any more hiding in the chat, Jill?
I think you're good.
Okay, awesome. Appreciate everybody joining us today. We're 3 minutes over, so I appreciate the extra time as well. Just real quickly, just want to mention, hopefully we can see a lot of you again next week, July 16th. We're doing our next webinar in our Back to Basics series. We have 2 outstanding hosts, Amber Haston and Samantha Asbra, and they're going to talk about mastering accounts receivable for year end. I think it'll be a great webinar as well.
Thank you guys for joining. See you later.
Well, thank you.